Welcome to Fitch Ratings Risks to Watch. Each video in this series will highlight the key credit concerns in a sector over the next 12 months. I'm Nathan Flanders, Global Head of Non-Bank Financial Institutions, and I'll be discussing shadow banking in 2019. Fitch Ratings broadly defines shadow banking as credit intermediation or liquidity transformation conducted by entities other than banks, central banks, insurance companies, or pension funds. We believe that entities that fit this definition warrant close scrutiny in 2019, particularly in light of their post-crisis growth, limited transparency, and modest regulation. Three shadow banking developments which would increase our concern in 2019 are further rapid growth, credit quality deterioration, and funding and liquidity pressures. Further rapid growth, particularly in the face of the currently competitive underwriting environment, would suggest that shadow banks are taking outsized or less transparent risks, potentially beyond their core areas of competency. Credit quality deterioration against the currently benign economic backdrop in most developed economies would also be of concern. In 2006 through early 2008, for example, financial pressures felt by certain shadow banking entities proved to be a precursor for broader market stress. Finally, funding and liquidity pressures stemming from reduced financing availability, more onerous financing terms, or mismatches between asset liquidity and liability maturities could impact shadow banking viability even if the underlying assets are still performing. Forced asset sales, such as from open-end funds, could have knock-on effects on the broader financial system, particularly if material leverage is employed. Fitch expects shadow banking to continue to attract incremental regulatory scrutiny at both the country-specific and international levels, as the sector continues to grow in size and potential systemic importance. That said, Fitch believes more meaningful regulation of shadow banking will be confined to specific countries, such as China, or subsectors, such as consumer finance, unless and until a market-wide shock emanating from shadow banking causes regulators to consider a more comprehensive regulatory framework. Regulation thereafter could include increased transparency in financial reporting, greater risk participation to improve alignment of interests, and limitations on asset-liability mismatches. However, the magnitude of these constraints would need to be balanced against regulators' desire to maintain credit availability, particularly for the underbanked. Initial indications suggest that steps taken by Chinese regulators have in fact slowed shadow banking growth within the country. This can be observed directly in terms of shadow banking balances relative to GDP and indirectly in terms of the interconnectedness scores that most major Chinese banks have reported under the Basel Capital Framework. Chinese regulators appear committed to continuing to slow shadow banking growth, but they face a delicate balancing act in trying to do so without impacting Chinese banks, the domestic economy, or financial markets more broadly. The true test of regulators' resolve will be their willingness to continue dealing with shadow banking risks if faced with broader economic headwinds. For all our 2019 Outlook reports, please visit our website.